Hello everyone, and a very warm welcome to this explainer. Today we're going to build some deep conceptual clarity from the absolute ground up on a topic that literally sits at the very heart of financial accounting. We're talking about the bank reconciliation statement. Now, I want us to go at a nice, steady, deliberate pace today. We aren't going to rush through this. We are going to decode exactly why financial records behave the way they do, so that by the end of our time together, the core logic behind reconciliation is just perfectly clear to you. So let's dive right in. To make sure we build a rock-solid foundation, we'll follow a very logical path. First, we'll cover banking basics. Then we'll contrast the cash book with the passbook, and after that, we'll uncover exactly why those balances differ, looking specifically at timing and errors. Finally, we'll bring it all together by preparing the bank reconciliation statement to put everything into perfect harmony. All right, let's get started with Section 1, Banking Basics and Record Keeping. To really understand reconciliation, we first need to establish our baseline. Fundamentally, why do businesses even use banks? Well, think about the massive volume of modern commerce. Dealing purely in cash is just impractical, right? And honestly, it's risky. So banks step in. They accept deposits, they lend funds, and essentially, they turn idle money into active business utility. And because nearly every single transaction a modern business makes passes through the bank, having a dual-sided record-keeping system becomes absolutely essential. We keep our own record, and the bank keeps a record too. Moving right along to Section 2, Cash Book versus Passbook. Now, this relationship is our core conceptual anchor. Let's clearly define the bank passbook. It is merely a copy of the customer's account, but in the books of the bank. I want you to pause and really let that sink in for a second. The passbook is strictly the bank's perspective. It represents the ledger account of you, the customer, but it is maintained by the bank to keep you informed of the entries that they have made in your account. So observe this comparison very carefully. The cash book is maintained by us, the business. The passbook is maintained by the bank. Therefore, in a perfect world, the balances in both books should be totally equal but entirely opposite in nature. Here's what I mean. Say you deposit 1 lakh rupees into your bank account. You're going to record it on the debit side of your cash book, because for you, that bank balance is an asset. But for the bank, receiving your money is a receipt. It creates a liability for them, because they eventually have to pay you back. So they record it as a credit entry in the passbook. It's exactly a mirror image. Which brings us to Section 3, Why Balances Don't Match. This is the core financial mystery we need to solve today. If both the cash book and the passbook are tracking the exact same money belonging to the exact same business, why in the world do their balances at the end of the month almost never match? I mean, theoretically, they should be absolutely identical, but practically, they rarely are. So why does this happen? Well, the answer comes down to 2 main culprits. The differences arise primarily because of timing differences and errors in recording the actual entries. We are going to systematically break down each of these causes, starting with the most common one. Let's look at Section 4, the role of timing. Timing simply means that a single transaction is being recorded at 2 totally different times in the respective books. Walk through the life cycle of a typical check with me to see exactly how this gap creates a temporary mismatch. Step 1, you, the customer, issue a check to your supplier. Step 2, because you obviously know you just issued it, you immediately reduce the balance in your cash book. But then comes Step 3. It takes days for your supplier to actually go deposit that check, and then for the bank to clear it and deduct the funds. The passbook is only updated days later. During those few days in between, your cash book balance and your passbook balance are absolutely going to disagree. We can systematically categorize these timing differences into 2 main scenarios. First, sometimes your cash book balance will be greater than the passbook. For instance, when you deposit checks into the bank, you immediately bump up your cash book balance. But if the bank hasn't cleared them yet, the passbook balance is still sitting lower. Conversely, the cash book balance will be less than the passbook balance when you issue checks that haven't been presented for payment yet. Another really great example of this is bank charges. The bank just deducts their fees directly, reducing your passbook balance instantly, but you only reduce your cash book balance later on when you actually find out about the charge. The underlying logic here is purely about who records the transaction first. Now for Section 5, Dealing with Accounting Errors. Aside from those natural timing gaps we just talked about, actual human mistakes do happen. Both the business and the bank can make errors, though honestly, it's much more common in the cash book. So, what kind of errors are we talking about? Well, the total omission of entries, recording incorrect amounts, entering a transaction on the completely wrong side of the book, like debiting instead of crediting, or simply getting the totaling and balancing wrong. Any one of these straightforward human errors is going to immediately throw those two balances completely out of sync. And finding these errors, that's not just some academic exercise. Reconciling these accounts regularly has become an absolutely essential activity for businesses. It gives management the critical opportunity to check for fraudulent activity and prevents serious financial statement errors down the line. Finding and rectifying these differences is a vital, real-world defense mechanism for literally any organization. Which leads us to our final section, Section 6, Preparing the BRS. This right here is the resolution to our whole mystery, the Bank Reconciliation Statement. This is a specific statement that reconciles the bank balance as per your cash book with the balance as per the passbook by explicitly listing out all the causes of difference between the two. Think of it as the ultimate detective's report. It totally eliminates the confusion by matching up all the facts and figures and bringing the two statements completely in line with each other. The utility of preparing this statement is really profound when you think about it. It helps you find out the actual, true position of your bank balance by incorporating the effect of those uncleared funds. It ensures that all financial transactions you incurred during the year are properly accounted for. Plus, any undue delay in the clearance of checks by the bank will immediately be highlighted through this reconciliation. Basically, it provides you with total financial transparency. I want to leave you with a final, somewhat provocative thought. Considering the timing delays and the inevitable human errors we've just explored together, without a proper reconciliation statement, are you really, truly sure how much money your business actually has at any given moment? Mastering the BRS isn't just about passing an exam. It's the absolute foundation of being able to trust your own financial data. Thank you so much for joining me in this explainer today. Take your time to review these core concepts, and I really look forward to exploring more accounting logic with you next time.